What is an imbalance and how to use it in forex trading? Understanding imbalance in forex trading. Imbalance in forex trading. Imbalance refers to a significant disparity between buy and sell orders, leading to rapid price movements. This can indicate areas where institutional traders or large market participants have placed significant orders, causing the price to move quickly through these levels with little opposition. Identifying imbalance. Characteristics of imbalance. 1. Rapid price movements, sharp moves in price within a short period. 2. Candlestick patterns, large candlestick bodies with little to no wicks. 3. Volume spikes, high trading volume during these sharp moves. 4. Price gaps, sudden jumps in price, often seen during news releases or market openings. How to use imbalance in forex trading. 1. Identifying imbalance zones. Volume profile. Use the volume profile indicator to spot areas with high volume clusters followed by low volume zones. This indicates an imbalance. Candlestick patterns. Look for large bullish or bearish candles with minimal wicks, indicating strong buying or selling pressure. 2. Trading strategies based on imbalance. A. Breakout trading. Identify breakout zones. Look for imbalance zones where the price moved fast. Entry point. Enter a trade in the direction of the breakout when the price moves back into the imbalance zone. Stop loss. Place a stop loss just beyond the opposite side of the imbalance zone to protect against false breakouts. Take profit. Set take profit levels based on the next significant support or resistance level. B. Reversal trading. Identify exhaustion. After a strong imbalance, look for signs of exhaustion, for example, long wicks, volume decline. Entry point. Enter a trade in the opposite direction once you see a reversal pattern. Stop loss. Place a stop loss just beyond the high-low of the imbalance move. Take profit. Target previous levels of support or resistance. C. Pullback trading. Identify pullback zones. Look for price pulling back to the origin of the imbalance after the initial strong move. Entry point. Enter a trade when the price touches the imbalance zone and shows signs of resuming the original trend. Stop loss. Place a stop loss below above the start of the imbalance zone. Take profit. Aim for the recent high-low created by the imbalance move. Practical examples. Example 1. Breakout trading. Identification. Your USD breaks through a resistance level at 1.1200 with a large bullish candlestick and high volume. Entry. Enter a long trade when the price retraces to 1.1200, the imbalance zone. Stop loss. Place a stop loss at 1.1180 below the imbalance zone. Take profit. Set take profit at 1.1300, next significant resistance. Example 2. Reversal trading. Identification. GBP USD experiences a rapid decline from 1.3500 to 1.3400 with a large bearish candlestick. Entry. Enter a long trade when a bullish reversal pattern, for example, a hammer, forms at 1.3400. Stop loss. Place a stop loss at 1.3380 below the low of the imbalance move. Take profit. Set take profit at 1.3500, previous support now resistance. Example 3. Pullback trading. Identification. USD JPY moves quickly from 110.00 to 111.00 with a large bullish candlestick. Entry. Enter a long trade when the price pulls back to 110.50, middle of the imbalance zone, and shows signs of resuming the uptrend. Stop loss. Place a stop loss at 110.20 below the imbalance zone. Take profit. Set take profit at 111.50, recent high. Additional tools and techniques. 1. Volume profile indicator. Helps in visualizing the volume traded at different price levels to identify imbalance zones. 2. Order flow analysis. Understanding the order book and flow of buy and sell orders can help identify potential imbalances. 3. Market sentiment analysis. Tools that measure market sentiment can provide additional confirmation for imbalance zones. Risk management. 1. Position sizing. Determine the size of your trades based on your risk tolerance and the size of the imbalance zone. 2. Stop loss orders. Always use stop-loss orders to protect against unexpected market moves. 3. Risk-to-reward ratio. Ensure a favorable risk-to-reward ratio at least 1 to 2 for each trade. Conclusion: using imbalances in forex trading can be a powerful strategy when correctly identified and executed. By understanding the concept of imbalances and applying it to breakout, reversal, and pullback trading strategies, traders can potentially enhance their trading performance. Combining this approach with proper risk management and additional analysis tools can further improve the effectiveness of the strategy. For more details, watch my other videos, subscribe, ask a question in the comments, or contact me via email. See you soon.